Good morning, everyone. This is Mike Minter. This is your Market in Minutes, and we are looking back on last week, of course, which was the week of the 23rd through the 27th of October. And of course, we'll be looking at what is on deck for this week as well. And one of those things is Halloween. So we got our little pumpkin here. Hope you guys enjoy tomorrow night. It's probably going to be a bit of a cold one down here in Houston. So stay warm. So let's jump right into it, guys. Last week was not great. Nothing to sugarcoat here. The market's kind of continuing to slide here with the fear of more rate hikes and also that in conjunction with the fact that yields are just rising in general. We had some numbers come out pretty recently where the Treasury is kind of bumping right around that 5% yield on the 10-year. It kind of goes up and down, but that's where it's kind of been hovering. So that's a bit of a concern. But again, as we've said, numerous times in the past, this rate hiking environment is going to be a little bit vicious as the bond market and the stock market digest this information. And so unfortunately, expect more volatility probably to come, but we'll get through it as always. But just kind of getting to the other side of this can be a little hard to stomach sometimes. So last week was a rough week, obviously across the board, broadly for stocks. Everything pretty much down, even overseas markets, as you can see. So we'll now kind of broaden that out and look at year-to-date numbers. Still strong numbers for the most part on the broad markets. The Dow, of course, we've talked about being these 30 stocks, which tend to be more on the value slow growth side. So and they've taken more of a hit this year. So wouldn't get too worked up about that. Still broadly up for the domestic markets and overseas markets as well. So let's take a look at kind of the story surrounding this. So this October slide continues, as we said. It's unfortunate, but it's what kind of has to take place as we enter this. What I think is probably getting near maybe the end of this business cycle. So stocks continued to slide last week, despite mostly better than expecting earnings, and earnings were good. They were really good, actually. So while earnings were generally positive, investors were troubled by the declines in year-over-year profit margins and a little bit of tepid guidance from some of the companies. So particularly on the technology side, pretty ho-hum in terms of the guidance. So particularly hard hit, where the tech companies. And they've been the highest flyers, so it makes sense that they take a little bit harder hit when news isn't nothing but great. Economic data released on Thursday showed, again, very strong economic growth. I think that was a surprise to a lot of people, with above average consensus forecast growth in third quarter GDP and September's durable goods orders, with only a minor uptick in initial jobless claims. So these results fan worries that the Fed might need to hike rates further, or at least maintain these higher rates for longer. They are meeting this week. So the Fed will be meeting Tuesday through Wednesday and expected to make an announcement on rates. It is broadly believed that they will keep rates steady, so continuing this pause. They could surprise there, but it's unlikely at this point that they would surprise and go ahead and raise again. But they are meeting again in December at some point, and it's possible, I guess, we could still see a rise this year, but it's not a consensus right now that we would see that. Whether or not we get that in 24, who knows? There's a long time between now and the end of the year. And one thing I'll say, folks, is just get ready for a lot of doom and gloom news as we head into this, what I think is at some point inevitably going to be an economic slowdown. It's the goal of the Fed to get us here. It has to happen. I mean, it's just the law of business cycles, right? And we've been through the longest business cycle pretty much in history here without a prolonged contraction. And it's just going to have to happen to get inflation under control and stabilize rates, stabilize the bond market. We have to have at least some semblance of a slowdown at some point, and that's going to happen whether we want it to or not. But it is a healthy thing. It's painful to go through, and nobody wants to go through it. But in order to get to the other side of this, in terms of the markets and the economy, you have to go through it. And hopefully that's softer as opposed to harder. We've talked about the soft landing, versus hard landing. Hopefully we can achieve that. But one way or another, we have to go through that. So get ready for a lot of doom and gloom news. That's their job. Remember, they're not in the prudent advice business. The media is in the fear business and in the doom and gloom, because that's what sells. That's what kind of piques people's interest. And that's what keeps them talking day in and day out. So just remember, whatever you read in the headlines, it's not always that bad. If it were, we wouldn't invest, because the markets go up more often than they go down, which leads you to believe that more often than not, news is actually good for the long-term markets. And that's exactly why we continue to invest. If it were the opposite, we wouldn't invest. There'd be no reason to. So just keep that in mind as you read these headlines that are always tending to be more negative than positive. So I'll leave you with that. Just my advice on that. So let's take a look at the economic data. So again, very strong. The first read of the third quarter was a blowout, with GDP increasing at an annualized rate of almost 5%. That pace is well ahead of the prior quarter's 2.1% expansion, and way above consensus forecast. So that was a bit of a surprise. Again, we're kind of in this good news is bad news, because that hit people in a funny way, because now it's the question is, wow, does that mean the Fed is going to have to even be more aggressive and possibly raise rates? So again, this is all in this delicate battle of trying to tampen down inflation, and by doing so, you have to some extent kill economic momentum, unfortunately. Powering the third quarter's economic performance was strong consumer spending and inventory buildup. And durable goods orders jumped 4.7% in September, confirming the nation's continued economic health and easily outpacing this 0.1% rise in August in economists' forecasts of 2%. Meanwhile, initial jobless claims slightly increased, suggesting that the labor market, again, remains very, very healthy and resilient. So still continuing to battle this kind of delicate balance is the Fed. So what's on deck for this week? So we have some key economic data coming out, and also many earnings, because we are kind of in the midst of this earnings season here. So Wednesday we had, as we talked about, the FOMC, that's the Federal Open Market Committee, the announcement. So we'll be paying close attention to that. Again, the consensus is rates will not change, but we shall see. So we have the ADP report, employment report, Institute for Supply Managers, the manufacturing index, that's a big one, and job openings and turnover surveys. So a lot going on Wednesday for sure. Lots to take a look at. Thursday, factory orders and jobless claims. Friday, Employment Situation Institute for Supply Managers Services Index. What's in store for earnings? As you can see, we got a pretty full slate here. I won't go through every one of them, but Monday we got McDonald's Corporation, Arista. Tuesday we got Pfizer, Caterpillar, some big names here. Wednesday we got AMD, PayPal, Humana. Thursday, Apple. That'll be a whopper. That tends to be a real mover. So we'll see what they have to say. Starbucks, Shopify, you name it. Friday, we got the Warren Buffett-led Berkshire Hathaway. So a lot going on this week, guys. We will, as always, we'll digest all that information. We will report back to you next week. Here's our information. Please contact us at any time. We would love to talk to you, clients and prospects alike. Check out our website. Follow us on YouTube if you want to get these videos just straight to you. And sometimes there's videos that you wouldn't otherwise get. So give us a crack on YouTube. So Guys, it was a pleasure as always. Here's a little disclosure for you. Enjoy Halloween, and we will catch you next week. Thanks, guys.